The view on the Indian economy and monetary policy has been changing once again. First, it was the minutes of the Monetary Policy Committee meeting, which made economists rethink the duration of a pause in rates. Now it's the rising oil prices. Of course, all of this has a bearing not just on bond markets, but also on the currency markets. Joining us, Radhika Rao, economist at DBS, on the phone line from Singapore. Radhika, good afternoon. Thanks so much for taking our call. Radhika, I guess my first question is linked more to the oil price scenario and also linking back to the MPC's minutes, which had already turned out to be a little bit more hawkish than expected. On top of that, we are now seeing oil prices remain elevated. Has the rate expectation changed at your end?
Hi, good afternoon. Thanks, Ira. I think for the second consecutive month, we've seen the minutes being surprisingly holding a very different tone from the policy statement itself. So I think where individual members' comments become more important. So there seems to be a common theme running across minutes in terms of their confidence on growth prospects and also about core inflation being much more, outpacing not only the headline, but also being sticky and increasing, rising up. So these two factors stood out for me. And as you mentioned rightly, so oil prices, the RBI has projected their own baseline projections is at $68. Right now, the prevailing price is about 75. That jump has to be also factored into their own inflation forecast, which I think at the next NPC report, we would see that being reflected. So what this means for rates, we had initially expected for rates to be kept on hold for 2018 and a rate hike in the first quarter of next year. We have brought that forward by 2 quarters, so we do think that the rate hike cycle could begin as early as September quarter. In the June before that, I think there might be a signaling of a shift in the stance. The central bank has retained a neutral stance until now, but you can see at least 2 or 3 members now shifting towards the hawkish part of the camp. So it will be a divided committee, but a slight marginal increase towards hawkish. So we would think that June would signal a shift, and thereafter factoring in monsoon, factoring in base effects going off and how sticky inflation still is, and core inflation as well. And of course, the elephant in the room, MSPs. So that's the other announcement that the central bank will await before actually moving on rates. So core inflation, along with the rupee that's depreciating quite fast, almost the regional underperformer, I think this will prompt the central bank's hand.
Okay, Radhika, so if rates do go up and if the tone gets hawkish from here on, what then does that mean for the currency from a trajectory standpoint?
Sure. So, as you know, earlier this year, we had a non-consensus call on expecting the rupee to depreciate. When rupee was at 60, 64 kind of levels, we were making a case, a two-fork case. Number one, that the market was, even last year and beginning this year, too optimistic on the Eurozone and too pessimistic about the U.S. outlook, which I think had shown in their currency movements as well. So now we finally see the U.S. dollar turn up gradually, and then you also see U.S. rates go up. Now, in this environment, coupled with higher oil prices, which does not bode very well for us domestically, it's not surprising that the rupee is bearing the brunt. So, in terms of forecast, we are running with a forecast of about 67.30 for the year, with further depreciation likely towards 68 and 68.80. So, the trajectory from here for further gradual, yet further rupee depreciation. So, I think if the central bank acts, its hawkish signals as well as a rate hike could provide temporary relief to the currency.
But Radhika, it must be said that while we could see depreciation, and some would say that depreciation is long overdue, there is no comparison in terms of the economic scenario now and say in 2013 when the rupee was actually slightly spiraling out of control. Right now it's depreciation, but it's controlled depreciation. I mean, both on inflation, fiscal deficit and current account, even though current account has widened, we are nowhere at the kind of levels we were at in 2013.
Absolutely. I'm completely in agreement. I think if you were to just look at the macro indicators, in isolation, a current account deficit of 2% of GDP is not troubling. right? I mean, EM in general, a deficit of about 2.5% is seen as pretty normal for any developing economy. So our size is not out of whack. So as compared to 2013, when we are almost more than double of that. Fiscally, we are still consolidating. States are a bit slower than the center, but still the overall picture is looking better. Inflation, again, is at 4%, 4.5% kind of levels, not as much as it was in 2013. So certainly it's weaker than where it was, I think, in comparison to the past 2-3 years, but nowhere close to where we were in 2013. But then again, we need to be mindful of the fact that when these kind of external changes especially happen, we're coming out of a phase when oil prices as well as liquidity were very favorable for Indian macros. So we had a good rally in the bond space as well as in the equity space. Now that support is weaning off. So now when that support goes off, how fast it goes off really will be a good test for how resilient the economy could be. So the first marker is, of course, the rupee. I think it has depreciated. Still not anywhere near record levels that we saw back then. But I think the pace of depreciation has been pretty strong. But I think once the markets adjust to the fact that the Fed is going to hike, it's going to hike gradually, but continue to remain hawkish, we would see sentiment stabilize. But that initial, I think 3 to 6 months, usually volatility tends to be higher. But certainly to reiterate, we are in a much better shape than we were in 2013. So I don't think the scale of depreciation will be very stuck too fast. And the authorities, I think, as they showed in 2013 as well as now, I think they're pretty much in top of things. So I don't think there will be a broad-based sell-off, so to speak. But still, we are to some extent beholden to what's happening globally.
Sure. Radhika, I have a question. If you can just help us understand, what is India's experience with oil-driven inflation? I mean, domestically, the debate has been whether excise duty should be cut to, comfort a little bit of the, soften the blow, the inflation blow. But when we get hit with oil-led inflation, does it generalize fairly quickly?
So the first level of impact from oil prices from the CPI basket particularly, it's much smaller. When we were on the WPI inflation as a policy gauge, the pass-through would be much faster of not only oil, of other commodities as well. But for the CPI basket, it's much slower. So, for instance, every $10 move only translates into 20-25 bits of increase in inflation and the headline inflation. So at this instance, I think the headline inflation will not see a big change just purely because of oil. But what it does is, I think, as always, we worry about the secondary impact where inflationary expectations become important. And if you trace oil prices and inflationary expectations, you would see in the past 2-3 years that inflation actually, expectations also softened from double digits all the way to about 7% because of, the sharp correction in oil and food as well. To answer your question, yes, I think the first level impact is not too much. The second level impact depends on multiple factors. It depends on how strong domestic growth is. But I think you can begin to see the difference in inflationary expectation. You also begin to see it in the manufacturing side of the story, where input prices go up and then gets passed on to the output price indices as well. So a sustained rise in oil prices, and if it holds up at 70-75 kind of levels, I think is a matter of worry for the central bank because, again, it is not so much the first level impact, but inflationary expectations that will start to play up. So I think hence the worry from the government, from the central bank perspective. But I don't think single-handedly, given oil's weight in the overall basket,
sure,
it will be enough to sway the trajectory altogether.